There's a problem costing banks between $25 and $42 million annually. Every single major bank. And retail crypto investors have absolutely no idea it exists. While everyone's chasing the next 100x memecoin or arguing about which layer 1 will flip Ethereum, there's a massive infrastructure failure happening in plain sight that XDC Network was specifically designed to solve. We're talking about trade finance reconciliation, the nightmare process of matching documents, verifying transactions, and settling payments across multiple parties, multiple countries, and multiple systems that still run on paper, faxes, and Excel spreadsheets. And in January 2026, with the $2.5 trillion trade finance gap holding steady and banks desperately modernizing their infrastructure, XDC just integrated with Zan Bank in the UAE, achieved MiCA compliance in Europe, and positioned itself as the only blockchain actually solving this specific problem at scale. Let me show you exactly what trade finance reconciliation is, why it's broken, how much it costs, and why XDC's solution is worth paying attention to even if you've never heard of reconciliation in your life. First, understand what trade finance actually is because most retail crypto investors have zero exposure to this world. Trade finance is the infrastructure that moves $9.7 trillion in goods across borders every year. When a company in the United States wants to buy manufactured goods from China, or when a European importer needs coffee from Brazil, or when an African exporter sells minerals to Japan, they use trade finance instruments to guarantee payment and delivery. The most common instrument is a letter of credit. It's essentially a bank guarantee. The buyer's bank issues a letter of credit promising to pay the seller once they prove they shipped the goods according to contract terms. The seller ships the product, submits documents proving shipment, and gets paid. The bank becomes the trusted intermediary between parties who don't fully trust each other because they're operating across legal jurisdictions, currencies, and time zones. But a letter of credit isn't just one document. It's a package of documents. You have the LC itself. You have bills of lading proving ownership of shipped goods, commercial invoices documenting what's being traded, insurance certificates, certificates of origin, inspection reports, pecking lists. Each document might be created by different parties. The exporter creates some. The freight forwarder creates others. Inspection companies create certificates. Customs authorities stamp originals. And every one of these documents needs to be verified, matched against the LC terms, and reconciled across all parties involved. This is where reconciliation comes in. Reconciliation is the process of matching documents and transactions across different systems to ensure everything aligns. Did the bill of lading match what the LC specified? Did the commercial invoice match the agreed price? Were the goods inspected according to requirements? Is the insurance certificate valid? Every single detail has to match across every document before payment releases. And here's the insane part. This is still done manually. According to EY, a typical trade transaction goes through numerous compliance checks during its life cycle, with each review racking up costs. A large trade finance bank can spend anywhere from $25 million to $42 million annually on risk, compliance, sanctions, and anti-money laundering tasks related to trade finance. And that's just compliance. The actual operational cost of processing documents, reconciling transactions, and managing exceptions is even higher. One global trade finance bank that EY worked with had a few thousand people based around the world manually processing approximately 9 million trade transactions each year. Think about that. Thousands of people, 9 million transactions, all manual processing. In 2026, when we have blockchain technology, AI, and cloud computing, the industry is still using paper, fax machines, and manual verification because the systems aren't integrated and there's no single source of truth. The cost isn't just in salaries. It's in delays. The average letter of credit takes 5 to 10 days to process, sometimes longer if documents don't match or there are discrepancies. During those 5 to 10 days, goods might be sitting in ports waiting for clearance. The seller hasn't been paid yet. The buyer hasn't received their products. And every day of delay costs money. Port storage fees, financing costs, lost sales opportunities, currency fluctuation risk. The reconciliation problem also creates what's called the trade finance gap. According to the Asian Development Bank's latest survey released January 15th, 2026, The global trade finance gap remained at $2.5 trillion in 2025, unchanged from 2023. That's $2.5 trillion in trade finance that businesses need but can't access. And it represents about 10% of global trade. Why can't businesses access trade finance? Because the manual reconciliation costs are so high that banks can't profitably serve small and medium enterprises. Processing a letter of credit for a $10,000 transaction costs the bank hundreds of dollars in manual labor. It's not economically viable. So banks focus on large corporations doing million-dollar deals. This leaves SMEs, particularly in developing countries, locked out of international trade. They can't get the financing they need to export goods or import materials. This limits economic development and concentrates trade among large players. And the problem is getting worse, not better. Deutsche Bank reported in late 2025 that polycrisis is driving trade finance digitalization. Higher interest rates, geopolitical tensions, supply chain disruptions, all of these factors are pushing costs up and making efficiency more critical. 46% of respondents in Europe, 51% in the US, and 54% in Asia mentioned digital banking capabilities as one of the key reasons for choosing a banking partner for transaction banking services. Banks know they need to modernize, but traditional digitalization efforts haven't solved the core problem. Why not? Because most bank digitization projects focus on internal systems. They upgrade their own databases, deploy better software for their employees, implement cloud infrastructure. But trade finance involves multiple parties across different institutions. The exporter has their systems. The importer has theirs. The freight forwarder has theirs. The banks on both sides have theirs. Customs authorities have theirs. And none of these systems talk to each other seamlessly. This creates what's called the reconciliation burden. Every time information moves from one system to another, it has to be re-entered, verified, and matched. This is where errors occur. A shipping date gets transcribed incorrectly. A product code has a typo. Currency amounts don't match because of different decimal conventions. And every discrepancy requires manual intervention to investigate and resolve. Banks have been trying to solve this for decades. In 2017, a consortium of 8 major banks, HSBC, Standard Chartered, BNP Paribas, Citi, DBS, ING, Bangkok Bank, and CTBC Bank, founded Contour Network. Contour was a blockchain platform specifically designed to digitize letters of credit and solve the reconciliation problem. And it worked. Contour successfully reduced letter of credit processing times from 5 to 10 days down to hours in live commercial transactions. But Contour struggled to scale. Operating a blockchain platform requires significant capital and technical resources. The bank consortium model meant slow decision-making and competing priorities. By late 2023, Contour shut down operations. The technology was proven. The use case was validated. But the business model didn't work under consortium governance. This is where XDC Network enters the story. In October 2025, XDC Ventures acquired Contour's entire platform, technology, intellectual property, and critically, the relationships with the founding bank consortium members. They're relaunching Contour with fresh capital injection, new governance, and integration with XDC's blockchain infrastructure. This is massive because XDC now owns the only proven blockchain platform for trade finance reconciliation with existing relationships at the world's largest banks. But why XDC specifically? Why not Ethereum or any other blockchain? Because XDC was architected from day one for this exact use case in ways that other blockchains fundamentally weren't. First, XDC has instant finality. 2 seconds. When a transaction confirms on XDC, it's final, not probabilistic, not dependent on waiting for multiple blocks. Final. For trade finance settlement, this is critical. Banks need to know definitively that a payment has cleared so they can update account balances and release goods. XDC provides that guarantee in 2 seconds. Ethereum has probabilistic finality where you wait for confirmations. That's acceptable for DeFi. It's not acceptable for bank settlement. Second, XDC has near zero transaction costs. Fractions of a cent regardless of network congestion. For reconciliation, you're processing thousands or millions of small verification transactions, checking document hashes, matching invoice amounts, verifying signatures. If each verification costs significant gas fees, the system becomes economically unviable. XDC's near-zero fees make massive-scale reconciliation possible. Third, XDC is ISO 20022 compliant at the protocol level. ISO 20022 is the global standard for financial messaging that every major payment system is migrating to. SWIFT uses it. FedNow uses it. Target 2 uses it. By supporting ISO 20022 natively, XDC can integrate seamlessly with existing banking infrastructure. A bank can send ISO 20022 compliant payment instructions that settle on XDC blockchain without translation layers or middleware. It just works. Fourth, XDC has a hybrid architecture with both public and private state channels. The public blockchain provides transparency and auditability. Private channels allow confidential transactions where sensitive business data doesn't broadcast to the world. When a bank processes a letter of credit, they need to include detailed commercial information, product specifications, pricing, contract terms. This can't be public because it's competitively sensitive. XDC's private channels solve this. Process confidentially, settle publicly for finality. Fifth, XDC is EVM compatible. This means developers can deploy Solidity smart contracts with minimal modifications. Banks don't need to hire specialized blockchain developers. They can use the massive pool of Ethereum developers and existing tools. This dramatically lowers the barrier to adoption because integration doesn't require learning new languages or rebuilding tool chains. Now let's walk through exactly how XDC solves the reconciliation problem practically. Under the traditional system, here's what happens when processing a letter of credit. The buyer requests LC from their bank. The bank manually reviews the request, checks credit, prepares documents, and sends them via SWIFT to the seller's bank. The seller's bank manually reviews the LC, verifies terms, and notifies the seller. The seller ships goods and submits bills of lading, invoices, certificates to their bank. The seller's bank manually verifies that all documents match LC requirements. If there's any discrepancy, documents go back to the seller for correction. Once verified, the seller's bank sends documents via SWIFT to the buyer's bank. The buyer's bank manually verifies everything again. If satisfied, they release payment through correspondent banking networks. The seller's bank receives payment and credits the seller. Total time, 5 to 10 days. Total manual verification points, multiple at each stage. Total opportunities for error, countless. With XDC and Contour, here's what happens. The buyer requests LC through a digital platform. The LC is issued as a smart contract on XDC blockchain. The terms are encoded in code. Required documents are specified with hash verification. The seller ships goods and uploads digitized bills of lading, invoices, and certificates to the platform. Their authenticity is verified through cryptographic signatures. Smart contracts automatically check that documents meet LC requirements by matching hashes, amounts, dates, and other parameters. If everything matches, payment is released instantly in USDC or Rus stablecoin, settling on XDC. The seller receives funds in seconds. Total time, hours, not days. Total manual verification, minimal, mostly automated. Total opportunities for error, dramatically reduced because verification is programmatic. The cost savings are enormous. Instead of banks spending 25 to 42 million annually on manual trade finance processing, they spend a fraction on platform fees and minimal gas costs. Instead of thousands of employees manually reviewing documents, you have dozens managing exceptions and monitoring automated systems. Instead of 5 to 10 day settlement, you have same-day or next-day settlement. And instead of serving only large corporations profitably, banks can serve SMEs because the marginal cost per transaction is near zero. This isn't theoretical. XDC already has $717 million in tokenized real-world assets on its network as of January 2026. Vert Capital has tokenized $369 million in debt and receivables on XDC. Mercado Bitcoin is issuing tokenized fixed income products. Arcax has launched tokenized money market funds from BlackRock, Fidelity, State Street, and a burden on XDC. These are real financial instruments settling on XDC blockchain, proving the infrastructure works at institutional scale. And on January 12th, 2026, Zan Bank in the UAE completed integration with XDC Network. This isn't a partnership announcement for future exploration. This is completed integration where corporate and institutional clients can custody assets on XDC Network through Zan's institutional-grade digital asset custody service. Zan CEO Michael Chan stated they're entering a new era where blockchain technology can serve as the foundation for more efficient and inclusive banking solutions. Why does Zan matter? Because they're a regulated bank making XDC their blockchain infrastructure, not running pilots, not testing, integrating it into their banking stack. And Zan is focused on bridging traditional finance and DeFi. Their clients are corporates and institutions who need efficient cross-border payments and trade finance. XDC is now their back-end settlement layer. When Zan processes trade finance for their clients, it settles on XDC blockchain using the reconciliation infrastructure from Contour. XDC also achieved MiCA compliance in late 2025 through partnership with Arcax. MiCA, the Markets in Crypto Assets Regulation, is the EU's comprehensive framework for digital assets. By being MiCA compliant, XDC removes regulatory barriers for EU-based institutions. Banks in Europe can use XDC without worrying about violating regulations. This matters enormously because European banks are under tremendous pressure to digitize trade finance and meet regulatory requirements simultaneously. And XDC completed SOC 2 Type 2 compliance in August 2025. This is an auditing standard for security and data handling that enterprises require from service providers. Banks will not use infrastructure that doesn't meet SOC 2 standards. XDC has it. They're also pursuing ISO 27001 certification, the international standard for information security management. Again, unsexy compliance work that determines whether institutions actually adopt. Circle integrated native USDC on XDC in August 2025 with cross-chain transfer protocol version 2. As of January 2026, there's $132 million in USDC on XDC Network. This provides stablecoin liquidity for settlements. When a letter of credit needs to be paid, funds can be transferred in USDC on XDC with instant finality and near zero cost. No currency conversion risk. No correspondent banking delays. Just instant settlement in dollar-stable value. Deutsche Telekom MMS operates a validator node on XDC. This is a major telecommunications company providing enterprise-grade infrastructure because they see institutional potential. When a Fortune 500 company validates your blockchain, that's not speculation. That's operational commitment. Now let's address why retail crypto investors don't understand this opportunity. Because trade finance reconciliation isn't sexy. It doesn't have viral marketing. It doesn't promise 1000x in 3 months. It's boring enterprise infrastructure solving problems most people don't know exist. But this is exactly where real value gets created in blockchain. DeFi is exciting. NFTs capture attention. Memecoins generate hype. But how many DeFi protocols are processing billions in real institutional transactions? How many NFT projects have partnerships with banks that process trillions annually? How many memecoins solve actual business problems that cost corporations tens of millions in operational expenses? XDC is infrastructure. It's pipes and plumbing for global trade. And while everyone's focused on consumer-facing applications, XDC is building the backend that institutions will actually use. The global trade finance market is $9.7 trillion annually. Even if XDC captures a fraction of reconciliation and settlement for that market, the value created is substantial. And because XDC tokens are used for transaction fees and network operations, increased usage directly drives token demand. Looking at January 2026 specifically, XDC is trading around $0.047 to $0.053 with a market cap around $880 million. That's down 76% from its all-time high in 2021. But the infrastructure being built is more advanced now than ever. The Contour acquisition, the Zand integration, the MiCA compliance, the Circle USDC partnership, the Deutsche Telekom validator. These are operational milestones that position XDC for actual institutional adoption, not just speculation. Price predictions for 2026 range from conservative $0.09 to $0.11 to more optimistic $0.15 to $0.30 if institutional adoption accelerates. That represents 91 to 538% upside from current levels. Long-term forecasts toward 2030 suggest $0.18 to $0.84 in scenarios where XDC captures meaningful share of tokenized RWA settlement and trade finance reconciliation. These aren't Moonboy numbers promising 100x. They're based on fundamental analysis of addressable market size, adoption timelines, and value capture. If banks spending 25 to 42 million annually on trade finance processing adopt XDC infrastructure that costs a fraction of that, the value created gets shared between cost savings for banks and token appreciation for XDC holders. Both can win. The risk is execution. XDC needs to deliver on the Contour relaunch. They need more banks to follow Zan's integration. They need to prove that trade finance digitization actually happens at scale, not just in pilots. They need regulatory approvals to continue progressing favorably, and they need to compete against traditional digitization efforts and other blockchain solutions. But the thesis is sound. Trade finance reconciliation is broken. It costs banks tens of millions annually. It creates a $2.5 trillion financing gap. It delays transactions by days when technology exists to settle in seconds. XDC has built specific infrastructure to solve this. They've acquired the proven platform. They've achieved the necessary compliance. They've integrated with the required stablecoin infrastructure. And they're deploying with actual banks processing real transactions. This is the big problem retail doesn't understand. Not because retail investors are stupid, but because trade finance reconciliation is hidden infrastructure that operates behind the scenes. You never see it as a consumer. You never interact with it directly. But it underpins the movement of $9.7 trillion in goods globally. And it's broken, and XDC is fixing it. Whether retail investors recognize this opportunity or not doesn't change the fundamental value being created. Banks need better trade finance infrastructure. XDC provides it. As pilots turn into production deployments, as more banks integrate, as transaction volumes grow, the market will eventually price in that value. The question is whether you position yourself before that happens or after everyone else figures it out. In January 2026, with Zan Bank Live, Contour relaunching, MiCA compliance achieved, and 717 million in tokenized RWAs already on the network, XDC is further along than most retail investors realize. This isn't promise. This is operational infrastructure processing real institutional transactions. And that's exactly the kind of boring, unsexy, fundamental value creation that generates sustainable long-term returns rather than speculative pump-and-dump cycles. The big problem retail doesn't understand is that trade finance reconciliation costs banks billions collectively and delays global trade unnecessarily. XDC solves it. And that solution might be worth a lot more than the current $880 million market cap suggests.